Hi, I'm Michael Taila, Director of Fixed Income at City National Rochdale, and welcome to this month's edition of Fixed Income Perspectives. The fixed income markets continue to face bouts of volatility, with investors navigating the frequent shifts in tariff policy and concerns about increased deficits from the budget bill working its way through Congress. While the underlying macroeconomic environment remains stable and supported by durable consumer activity and a steady labor market, concerns over the deficit and declines in the US dollar are putting pressure on long-end yields. On the other hand, both short and intermediate maturities continue to be met with strong demand. These trends have impacted the shape of the US Treasury curve. In May, for example, US Treasury yields increased by about 25 basis points across the curve, with the 10-year trading near 4.5% and the 30-year exceeding 5%, as investors demanded a higher premium to own longer-dated bonds. Against this backdrop of volatility, May delivered the first negative monthly return on the year for U.S. Treasuries. However, year-to-date, the asset class has rewarded investors with positive returns over 2%. While U.S. Treasuries have been volatile, credit markets have been anything but. If you recall, the market reaction to initial tariff announcements in early April led to some widening in investment-grade and high-yield corporate credit spreads. However, following the temporary 90-day tariff pause, corporate credit spreads have fallen swiftly back to January levels. This improvement has been supported by steady investment demand, as well as positive credit fundamentals. While there is uncertainty about the timing and magnitude of policy shifts that could have implications for growth, we see valuations as relatively balanced against market risks, but we remain guarded in our credit review and selection process. We continue to believe active management is important in the current environment, and we view the attractive levels of income available today as a value add for well-diversified portfolios. Shifting our attention to the municipal bond market, we continue to view this sector as a longer-term investment opportunity, despite some underperformance this year. The volatility in municipal bond prices has caused yields to rise, making tax-exempt yields more attractive relative to taxable bonds. With the municipal yield curve steep versus comparable U.S. Treasuries, investors can earn excess income by moderately extending maturities and improve forward return potential from increased tax-efficient cash flows. To help illustrate the relative value, a 10-year AA-rated revenue bond currently yields about 3.6%. For investors subject to the highest federal tax bracket, this equates to an equivalent yield of approximately 6%, exceeding both comparable U.S. Treasury and AA-rated corporate bonds. Also helping make the case is overall credit stability and a continuation of solid investor demand relative to above-average municipal bond supply. Fixed income markets will be shaped by a mix of economic data and evolving trade policies. Stable underlying macroeconomic conditions, positive momentum on trade negotiations, and clarity surrounding tax policy will continue to improve overall market sentiment. Still, volatility persists across rates, and we maintain our outlook for 1 to 2 Fed rate cuts this year, with the 10-year yield likely to trade within a 4 to 4.5% range. Despite this, credit conditions remain solid, especially in investment-grade municipal and corporate markets, where we continue to find opportunities. Thank you for watching this month's edition of Fixed Income Perspectives. Feel free to reach out if you have any questions.